Welcome to this Fund Manager Q&A brought to you by Livewire Markets. My name is Vishal Teksnani. On the show today, we have Andrew Schwartz, Group Managing Director and founder of Qualitas. Andrew looks after the Qualitas Real Estate Income Fund, which invests in real estate debt securities. So Andrew is really well placed to talk about what's happening in the property debt market. Andrew, welcome to the show. It'd be great to kick off with your thoughts about what's happening in real estate debt securities on the back of COVID-19.
In respect of COVID and the effect on property, what it really does is redefine the term prime property. So whereas previously people would have thought about prime property as perhaps an office asset on Collins Street, it now makes you look directly at where the source of income is from the property itself. So perhaps prime property has been decoupled from location to looking at where the source of income is. So assets such as an industrial asset or a food manufacturing asset might be considered to be more prime at this particular point in time as a result of COVID itself. In terms of how we're thinking about it at Qualitas, our view is that, we're really thinking that the pandemic and the lockdown effects might be in place for a 6-month period. That's really working off the most recent government guidance type statements. And in particular, therefore, in terms of the underlying real estate, how does that affect the various property assets and classes that we're in? The Real Estate Income Fund focuses on a number of different asset classes. One of those is investment assets themselves. And those investment assets can be areas such as hotels and leisure related activities, which clearly would be more impacted as a result of COVID. And there'll be other assets that we consider to be investment class, such as industrial or assets that have long-term secure income that we see as benefiting from COVID. So again, it's not a generic one size fits all across all asset classes. You do need to look at it on an individual by individual basis. One of the other aspects of the income fund is that it is involved in construction loans themselves, and those construction loans have very significant levels of equity that sit behind the income fund. And again, we think they're well placed to withstand a elongation of duration should that effect actually occur.
Okay, so if we take that and overlay it onto your strategy, what does it mean for the fund?
I think what it means is that providing debt secured against real estate at this time really allows investors to have some level of capital preservation and protection, because you have got equity buffers that sit behind the debt that absorbs any reduction in values of the underlying properties themselves. So from that point of view, we think that it does limit the downside to some extent to the extent that COVID is actually affecting asset values. I should add that COVID does also bring with it various opportunities, and some of those opportunities relate to where we are in the cycle, particularly by way of pricing of loans and also by way of general terms and conditions of those underlying loans. In particular, what we're finding is that pricing has become more advantageous for lenders at this particular point of time. And also just the levels of leverage that are being employed by the alternative debt sector groups such as ours, are finding you're able to get those higher returns with more modest amounts of leverage at this point of time.
Okay, so are we able to kind of quantify here those opportunities? So would you be able to talk about what type of pricing perhaps and deals perhaps that you were able to obtain pre-COVID-19, and how does that look like now? If you can quantify any improvements in yields or loan terms.
Sure. So previously, it's fair to say that the Qualitas Real Estate Income Fund, QRI, was not an aggressive lender leading up to COVID. In fact, I think that it always maintained a very high level of discipline, but it was operating in 2019 in a very competitive environment. And what it really sought to do was to compete on price more so than on the general terms and conditions, such as loan to value ratios. But what we are finding is that perhaps a loan that would have been written at 65% loan to value and 6 or 6.5% type gross return might now be literally at 50 or 55% loan to value with a plus 100 to 200 basis points relative to pre-COVID pricing.
Okay, so and that sounds very attractive from a yield perspective, but what are the risks? We are in the situation, and ask a commentator, the responses range from 3 months to 6 months to 12, 18 months of potential impact on the economy. How are you planning for various scenarios and periods of lockdowns, and how are you thinking about it from a risk management perspective?
Thank you. Yeah, it's as I was saying earlier, one really needs to look at the underlying security itself. So the QRI has 3 primary classes of assets. The first one being the investment loans, and those investment loans do source income directly from the property themselves. So perhaps unlike a traditional debt fund that might have corporate bonds, corporate receivables, that's not the nature of QRI. It is a fund that takes mortgages on property and sources income, not just from tenant-related activities, but also from the borrower's wider groups. That the types of borrowers that have taken on loans from QRI tend to be those that are mid-sized borrowers who have quite substantial levels of diversified assets. So those investment loans really benefit from the fact that the borrowers themselves have wider pools of underlying securities and rentals that exist. We don't have, we've got 1 hotel in the portfolio. We've got 2 retail assets in the portfolio. They're very much at the minority, but the loans themselves, 98% of our total loans are supported by personal guarantees. And accordingly, you're really getting the benefit of wider assets, within the group. Approximately half the loans have the benefit of an interest reserve account. So they were established at the time of inception of the loan. And what that enables us to do is, to the extent that a borrower did find themselves in trouble, and just to emphasize that at the moment, we haven't found ourselves in that position, but to the extent that a borrower did find themselves in some trouble, we have got interest reserve accounts that we can draw upon that enable the interest to keep getting paid, and for the asset to be dealt with at the underlying asset level as well.
Okay, so you've got quite you've got quite a number of protections in place then.
That's correct. And I think what it does do is say that the underlying value of the property itself, your first order of protection, is the fact that, as I said earlier, the loan to value ratio for this portfolio on average is 64%. So by implication, you've got 36% of equity that sits behind you that is your first order of protection. But backing that up is the cash flows of the underlying property, the wider cash flows of the borrower themselves, and the personal guarantee of the borrowers, all the way through to the director level of the owners.
Okay, and so none of those securities have seen any type of a cash flow issue right now?
So as we announced a portfolio update to the ASX last week. What we did note in there is that we have got 1 loan at the moment that we are restructuring that sits in the QRI portfolio. That particular loan represents 1.2% of the total assets of the portfolio, and we are restructuring at the moment in terms of looking at the underlying borrower putting more equity into the transaction itself. We do feel that we are well secured on that particular position, but we also feel, for reasons confidential to the borrower, that it could do with more recapitalisation at the underlying asset level itself.
Okay, and so can you walk us through what a restructure means for your end investor, and do you expect any more restructurings to occur if we persist with the level of economic activity that we're seeing right now?
So we do, the great thing about QRI portfolio is the fact that it's a relatively simple model in that it's not thousands and thousands of loans. It's 30 loan positions. So what that enables us to do is we know every borrower and we know every underlying security. And what we're able to do is continually assess and reassess the position of the borrower and the underlying security. Now, we announced last week that as at the 31st of March, which was the last date of our formal review process, we had no impairments of the underlying assets. Now, that's not a guarantee that you can't lose money on a particular loan and that you have indefinite or perpetual stability to your underlying asset prices in your loans, but it does say that based upon all available information to us as of the 31st of March, we did not see any reason to raise any specific impairment against any particular loan asset that's currently in the portfolio.
Okay, all right. So let's drill down into your latest NTA report. You had an NTA at 31 March of $1.60, but the share price has been trading at $1.40. Is trading at around $1.40. Can you help explain to investors that disconnect within the price and what you can do to close it, and what are some of the other factors that you may need to see that gap close?
Sure. Okay. Well, it's hard for me to explain the disconnect because we think the NTA is $1.60, but I suspect the core issue there is really there's been a systemic setback in equity markets across the board. And I think that, not just QRI, but really all the credit LITs and LICs, are currently trading below NTA. I think it's pleasing that, QRI is probably, in the least discount, if I can use that term, relative to its NTA. It's approximately 12.5% discount. I do think it's really a case of those that require, liquidity, could be effectively, selling the stock at this particular point of time. We're very focused on that particular aspect. One of the basic investment thesis behind QRI itself was the fact that we're looking to provide regular monthly income. And, for the last 12 months, that regular income is just shy of 6% based on a $1.60 unit price. As I was saying earlier, I think the conditions for lenders are becoming more favourable in terms of pricing at the loan level, which, if that is correct, should feed through into higher returns for a debt trust such as QRI as well. And therefore, at a discounted value, you'd see that stock hopefully, quite sought after for the ongoing income yield, because obviously at $1.40, it's providing, quite a good yield as a result of the discount. We are very focused on the discount. We also announced in the last couple of weeks that we're prepared to undertake unit buybacks. And that's really, those unit buybacks are really designed to close the gap between the unit price and the actual NTA to the maximum extent we can.
Okay, so and let's focus in on that yield which you mentioned just there. And if we think about the beginning of our conversation, you're securing more attractive loan terms on your deals, including higher interest rates. But you also mentioned a restructuring. So kind of, if we bring all these factors together, do you expect the dividend yield to stay where it is, or perhaps improve or decrease a little? And do you expect the frequency of distributions to continue?
Yeah, so it's hard for me to make a forecast, obviously, given ASX listing rules. So making a guidance statement is difficult. But I will say a couple of things at a very high level. As per our portfolio composition at the 31st of March, our portfolio was 20% in the form of cash. So the more we deploy that cash, the more accretive it will be to the total return of the fund. At the moment, that cash is earning approximately 0.5% deposit rate of interest. So to the extent we can deploy, it will be favourable to underlying yield. The second aspect is, as I mentioned earlier, that we've seen a lot of the local and offshore competition come out of the alternative debt market. And as a result of that, there's more favourable risk premium pricing attaching to new loans. So you'd think that would go in favour of future yields. And the third aspect is that the average maturity of our underlying asset positions is approximately just a little bit over 6 months. So that gives us this constant ability to relook at the terms and conditions, not necessarily in an opportunistic way, but rather to get back on a solid, more normalised pricing, which again, to the extent we can achieve that, would be favourable to the underlying return of QRI.
Okay, before we finish, I want to ask you 2 more questions on bigger picture things. So if we start off with listed versus unlisted valuation declines, it's been pretty interesting whether you look at property, whether you look at infrastructure. Listed assets have borne the brunt. How do you explain, or do you have a view around the valuations between listed and unlisted assets and what they're going through?
Yeah, so with listed equities, you find the adjustment process is extremely rapid. So it's very much based upon sentiment and forecast, and it happens, literally in a matter of days. In the direct property market, those adjustments can take quite a significant period of time. The act of an owner putting property on the market, running a selling campaign, and then effectively executing on a transaction can often take, several months of time. So I think the direct property market can have a lag effect, and to that extent, some of that would be coming through. I think that on the listed equity side, those that might be holding more retail or more hotel in their portfolio could be, taking more of an equity, revaluation at this particular point of time relative to other property asset classes. But I am often asked that particular question, and I do think that, as I say to a lot of our investors, it is about patience as well for those that are looking for more value-based acquisition opportunities in the direct physical market, and it does have some element of time. I think we need to bear in mind that this is an event-driven outcome, that this is not a financial credit market event that is actually happening here. And so, and I say this, in a sense of feeling unhappy and unfortunate that, this is really going to affect the smaller end of property in the direct market. Those that might own the strip shopping shop and has a cafe that is closed for business and is indefinitely closed for business at this particular point of time. Or maybe it's, backpacker residential or co-sharing, residential living, and those that, were casual workers that were dependent on their casual jobs to support the income level. I think that's where it's going to be very much felt. I think also it depends on the extent to which people feel distress and therefore are forced to sell as well. There's an old saying that time is your best friend in property, and to the extent you can see through cycles, then your property generally always recovers, through the cycle. And for the larger listed groups, and for groups such as QRI, that in our case we have no debt whatsoever at our trust level, I think it is a through the cycle investment. But unfortunately for those at the lower end of the property market that are forced to sell, there could be over time, some reduction in values that's felt by that sector of the market.
Okay, and that's a good segue into the last question. There's certain subsectors within property that are going to suffer. And I also liked how you mentioned at the beginning, this is going to redefine what's a prime asset. So if you were to think about, say, the world 3 to 5 years out, what type of property do you think will be the most attractive? The loans, the property loans that you'd want to make, and what would be the areas that you'd want to avoid on the back of this?
So if I take some of the asset classes, I would say I continue to really like residential. I think that going into COVID, the residential market was already in some form of equilibrium at the time. And whilst a lot of our residential market is driven off immigration, and clearly immigration is going to be a lot lower over the next 1 to 2 years relative to what it has been in the past, I think it would be a big call to say that we're going to have no immigration in perpetuity. So immigration will make a comeback. And I think that residential property is always going to be a very defensive type of asset class within the property sector. We really like industrial. The work from home and online shopping is redefining industrial in many ways. Property that's associated with digital data centres will continue to find favour. Properties that enjoy triple net leases from government-related income or food manufacturing will continue to do extremely well. And I think in the shorter term, challenge property will be areas such as hospitality and leisure. Retail could really find themselves, having to work through this particular phase of the market. So I think from our point of view, as a debt provider, it really comes back to, what levels of loan to value were we prepared to provide against those various assets, bearing in mind we're not the equity in those particular asset classes. And for us, it really is about what's considered an acceptable leverage level and at what price are we prepared to deploy our capital against those particular asset classes.
Thanks, Andrew. That's really informative. Is there anything else you wanted to add?
One comment I would add is that just really around, the competition and how that affects a group such as Qualitas. And so what you do find if you're in a 2019 type period is that you do have quite a significant amount of offshore capital that looks to Australia as a place for investment. And typically that's because the return profiles in, say, the US or Europe themselves become very competitive. Australia generally trades at a risk premium in excess of those larger markets. And what you find is some of those larger lenders who say, I've got a great idea, why don't we go to Australia to seek better returns than what we can find in our home market. I think what this part of the cycle actually does, and particularly because Australia is faring relatively well compared to, say, the United States and some parts of Europe, is that for those alternative lenders that are seeking value, they tend to find better opportunities in their own backyard from a pricing point of view, which means less overseas capital coming into Australia as well. And so I think for those putting a lender's hat on and for those in the debt market, that does provide, better pricing opportunities for the local lender. So that would definitely be, one further point I'd like to make. And perhaps one other point is really around, what lessons can we take out of this particular cycle relative to previous cycles? If you're happy for me to move on to that question.
Yeah, I'd love that.
Okay, so in terms of the long-lasting trends that I expect for property as a result of COVID-19, I think that this is the third major cycle that I've personally worked through, and it's interesting to compare what I think are the longer-lasting effects of this cycle compared to other down markets that I have experienced. And I think the things that are similar to previous cycles is, for borrowers to think about the amount of debt that they take on, not just at the asset level, but at the corporate level. That lenders not to underwrite growth, and I think thankfully QRI has not underwritten asset growth in making any of its decisions, and also to remember that time is your best friend when it comes to property. In respect of working through the particular cycle. But I think the main difference between this event and say 1991, just to show my age, and also 2008, is that this is very much an event-driven outcome, and there are some sectors of the economy, such as hotels and leisure-related activities, and those that rely on patronage from what is COVID-affected income, that will take longer to recover through this particular event. So that's probably what I see as the longer term outcome of the COVID pandemic. Thank you.
No, that's really interesting. And look, I'd like to finish off on this question. What you mentioned about pub patronage there, similar story with that strip in Collins Street who are relying on customers from office buildings. Do you reckon the landlords of these property assets can overcome these challenges? You're seeing shopping malls disrupted. Who would have thought this would happen to the office market? Do you reckon that they can reposition?
Yeah, I think the actions of government have been extremely commendable in respect of how they're handling, this disruption. That's probably, my other major observation of, this setback relative to 1991 and 2008 in terms of the intervention by government to look at the capital markets and financial system. And whilst a lot of landlords no doubt would have wanted across all states there to be rent assistance provided by government, I do think the openness of a landlord and a tenant to discuss some sort of rental abatement and in effect the capitalising of rent payments that can't be made over hopefully the next 6 months, all the way through to those landlords, financiers, for dealing with the major banks and looking at hardship loans. I do think government setting up through their AOFM, the Australian Office of Financial Management, their structured finance fund that can assist parties who are in hardship to pay interest, are really all programs designed to buy landlords and also their tenants time to see through COVID. There will be life after COVID. This is a narrow corridor of time, and all of these programs are really designed to construct a bridge for people to walk over to the other side, to allow normality to return to the tenant and landlord market. So I think to that extent, the government actions have been commendable in a number of matters.
It's really informative. Andrew, thank you so much for your time. Really appreciate it.
It's been an absolute pleasure. Thank you very much.